everybody, Michael Silva here. It's that time. Jerome Powell is going to be hitting the main stage, and we're going to talk about what the market's expecting going into this meeting. Now, there are no guarantees in life, according to Jerome Powell, but we will be talking about probabilities. As you can see, he's demonstrating what a distribution curve looks like here. That's a normal distribution curve. If he breaks it even further, we end up with a paranormal distribution curve. We got a lot to discuss on today's market brief. If you haven't done so already, make sure to hit that thumbs up. It's greatly appreciated. We're going to get right into it today. Look at today's price action, rather unchanged on the day. Okay, we saw a lot of volatility as we expected and continue to expect, but rather unchanged other than the NASDAQ Composite and the NASDAQ 100. What led the way? Materials, tech, and energy. Now, Microsoft and Google, they reported after hours. I can't tell you exactly where they are now, but Microsoft came down to just around that expected move for the earnings play. And then Google over here is just trading right around its upper expected move. So Google's looking good. Microsoft's looking good. We had other names report I'm not going to talk about at this particular time. So what is the SPY and the Qs doing after hours? They're slightly down as of this recording right now. Where we open may very well change this. Now tomorrow, right, the Fed is going to be coming in and talking. So we're going to talk about what the market's pricing in as far as expectations. We're going to show you why those expectations are always so important, especially if you're looking at this market from a weekly perspective, a daily perspective, a quarterly perspective, and so forth. So what is the market pricing in as of right now, what the Fed is going to do? Well, there's a 98% probability that we're going to get a 25 basis point hike. Nothing new there. We got a 1.7% probability that we're going to get a 50 basis point hike. So most likely, we would assume that the Fed is going to come out and they're going to raise it 25 basis points. That's what the market's pricing in. However, if they come out and they say we're not going to raise it, that would be a shock to the market. Okay, so that would be more of a surprise. So the market would respond at a greater rate, most likely positively, if the Fed came out and did not raise rates. Now, if they went 50 basis points, that would also be a shock to the market. Why? Well, because there's only 1% that believe that they're going to do a 50 basis point hike. Okay, so that could be very poor and bad for the market, or they can perceive it as poor and bad. Now, if we take a look here, what else do we got going into tomorrow? Before the open, we have AT&T reporting, we have Coca-Cola reporting, a bunch of other names, but then we also, after the close, we got big dogs like Meta. We also have Chipotle that's going to be reporting, but the big one most eyes will be on, most likely, will be Meta. That's going to come after the close. So if you're going to be trading that, just be aware. If you have positions, be aware to always pay attention to what the market's pricing in as far as expected moves. As we've already pointed out, boom, they come in very close, if not tag it to perfection. Doesn't mean you can't go outside of it, but remember, we talk about probabilities, the distribution curve, right? 68% of the time finishes within these or tags one of those levels. That's 68% of the time, there's still a probability that it gets outside of it, which is why we talk about 2 sigma moves. Now, going into tomorrow's trading session, I'm going to give you what I share with my Discord community. If you don't know about that, you can just click the link in the pinned comment or the description, and you can see what it is that I offer there. The expected moves, this is something that I share daily with the group, and I share it with these products. Why these products and not more products? Well, these are the ones that have daily expirations most of the time, except IWM, right? Boom, boom. That one's frequent, but it's not every day. So there is daily expiration tomorrow for IWM, so I included that there. We have the expected moves in this column. We have the upper level, we have the lower levels, and we have the 2 sigma levels there too as well. So if you want to screenshot this and put the levels on your screen, we can. So why are they important? Well, take a look here today at SPY on the 15-minute time frame. Yesterday, we talked about the 5-day moving average. It was inclining. What does that equal? Bullish. Okay, bullish. We're above the green line, which is the quarter-day anchored VWAP, which equals, that is bullish as well. Okay, we are right at that week-to-date. We said if we get and hold above that week-to-date, that is also bullish. Okay, so we have above this is bullish, above that is bullish, above this is bullish, and the overall price action is still putting in higher highs and higher lows. However, price was, well, right down here. Okay, so we're basically sitting on the 5-day moving average. So what do you do in this point when we knew where the daily expected move was here and here? Well, we said if we start to break prior resistance, that opens the door to come for the upper daily expected move. So we broke it, we came up, we trudled around, we came to it, and it acted as a potential level of resistance. So this right here was a pretty positive trade. Now remember, we can have 2 sigma moves in either direction too as well, but we're dealing within probabilities here, which helps us feel a little bit more confident when entering trades from a risk to reward standpoint. Now, going into tomorrow, what does the expected move look like? Well, it's bigger. So what does this mean? It means that the market is pricing in bigger expected move because we have an event. We have a catalyst, something that could potentially bring in more volatility. All right, so if there was less volatility, this would obviously be a lot smaller of a range. So how do we go about looking at this? So I would say we got some resistance here. So we anchored a VWAP to this swing high, which was a new high for 2023 today. And we anchored a VWAP to it, and you can see its price is just below that. Okay, so we're in bullish context, above the 5-day, above the quarter to date, above the week to date, but we're below this prior swing high. Okay, so what would we do if you're bullish? Well, you'd want to get back above this anchored VWAP from the swing high. That's one thing, okay? And then if I just draw a line of resistance right over here, you can see we could potentially be forming a cup with handle sort of type of pattern, and this could potentially break out. So you'd want to pay attention to this neckline right up in here. So if we start breaking through this level, that opens the door to the upper daily expected move and the upper weekly expected move. And it doesn't mean it has to go in a straight line. Doesn't even mean it has to make it. It can go like this, or it can go like this and fake us out and come right back down and boom. You know, that's always a possibility, but that's why you have to always look at where could potentially the risk be, or where can you put a stop loss. All right. So that would be from the bullish perspective. As far as the bearish perspective, right? I would not, personally, like if you short right here, you can get lucky and it can come all the way down and you win. Woohoo! Okay, but you just got to be mindful that if you are shorting, it requires you to be very tactical, because it could just be a time where we go down like this and then we fire off like a rocket ship right back up. Okay, so from a bearish perspective, you'd want to see series of lower highs and lower lows, which we just don't have. You'd want to take out this low, which was, you know, today's low or yesterday's low, or not yesterday's low, but just about today's low, or potentially this one, or potentially this one, or well, potentially this one, right? A series of higher lows. Okay, so as it stands right now, if you're bearish, you'd want to get back below that 5-day moving average. You'd want to get back below the week to date there too as well. And you'd want to see a series of lower highs and lower lows start to build. Remember, to be more bearish, the 5-day moving average has to start to neutralize and then start to decline. And that opens the door, obviously, to the lower daily expected move. And if you just go to the left, boom, if we come down to the lower daily expected move, bring it out even further, you can see this was actually a prior area of resistance, resistance was broken, can potentially become support. So even if we price were to just make a quick snap down to these levels, understand this is not where you'd want to short. This might be where you'd want to actually take profits if you're in a short-term shorting position. But remember, you can still bounce back up while the 5-day moving average is rolling over, and there's opportunities later down the road to potentially short back down and through. Let's move on to the cues. If we take a look at the cues on the 15-minute time frame, what you can see here is we tagged that upper daily expected move, and we got slightly above it, and we started coming back down. We had that declining 5-day moving average. Tomorrow we have a new expected move, right? For the daily, 383.55 to the upside, 374.01 to the downside. So how do we get bullish? How do we get bearish? How do we perceive this? Well, this looks a lot different than the SPY, doesn't it, right? The 5-day moving average is actually not moving up. It's not inclining. It's actually declining. So to be more bullish here, you would want price to get back above the 5-day moving average, maybe not such a straight shot, but maybe to potentially build a series of what? Higher lows and price action to tighten up. Okay, something like that, where then it breaks up through the 380 level. That opens the door, right? Because if we just were to draw a line, once again, right through the screen like this, I'll draw it out even further, you can see we had prior support. Once support was broken, it flushed down. We came back up, couldn't quite get to it, but now we came right back up there again, and we started to act as resistance. Now, we are above the quarter to date, but it's no longer really inclining as it stands. It's starting to flatten out. Okay, the more this flattens out means it's more likely to potentially break at some point. We'd want this to start turning back up to be much more bullish. As you can see, price action went up. This went up when price action was coming down and we're flooding around it, which we discussed yesterday, right? We talked about price action was contracting. It was coiling up. We said it must hold this level. If you're bullish, it broke out. boom, it opened the door to where? It opened the door to the daily expected move. Okay, so that was a cool little trade there if you were able to catch that. But now, right, we coming into the 5-day moving average, price action went on a big tear. We have the earnings that are going to be, obviously, we'll see where they open up tomorrow on Google and Microsoft. But if price action were to come down further, take a look at the week to date, then the quarter to date, and then below that is 374.01, which is the lower daily expected move. Those could be potential levels that you can create trade ideas around depending on what price action looks like if and when it gets down there. So if you are bullish and you find this as this little wedge pattern is going to continue to the upside, keep in mind that you'd want price to obviously hold this gap level, or maybe you turn around it. So this was the gap from today, came up, we pulled back, we went up. Okay, so you'd want this. Sometimes gaps can act as levels of support. That could be coming right into this area. And then if we start, doing something like this, basing out and breaking back out, we might try to go retest the 5-day moving average. Now, maybe something happens overnight where the market opens above. Okay, well, if that's the case, then that's pretty bullish to start the day, but you'd want the price action to hold above it and the 5-day moving average to start to curl back around. And then you'd want to see a series of a higher high, higher low, and then potentially break through that high to come for that upper daily and upper weekly expected move. So that's what I would be kind of paying attention to. Now, if we zoom out even further, let's take a look at where we stand on a monthly time frame with the monthly expected move, what the market was pricing as far as how much risk for the month. Well, we tagged the upper monthly expected move, and we're not too far off of that level for the S&P 500. The quarterly expected move, which we have another month to go, is up there around all-time highs. The Qs we talked about as soon as it started getting back over this monthly expected move, and it started pulling back in. Remember, 68% of the time closes within the expected move. So that's the probability. So would it be smart to go long right here when it was here, a few days ago or a week ago or whatever? No, it's not the greatest time to go long because the market priced in these moves and we're outside of what the market expectations were already, and there's a 68% probability that we close back within it. Okay, so it's a good time to what? Potentially take some profits out there or update stop losses, and there's just a various number of reasons things that you can do. It just depends on what your time frame is when you're trading. If you take a look at IWM, we are standing right there on the monthly expected move there too as well. A cool indicator that I talked about yesterday, but I didn't show you, was the Nysey-McClellan oscillator. And I wanted to bring this up because I wanted to show you the times that I've seen negative divergences. Boom, the red, boom, we sold, we sold, we sold, we sold. And now price action as it stands for the New York Stock Exchange, the NYA, it is getting very tight and pressing higher. Why we have that negative divergence. So most likely we're going to be seeing a break here at some point. Is it to the downside? I don't know. But remember, markets move between expansion to contraction and back to expansion again. Okay, that happens time and time again. We're getting coiling up right here. So to see a breakdown as we're seeing weaker internals makes sense to me. But remember, the Fed can throw a curveball, which can obviously be perceived as good news, and the market can just fire off even further. If we take a look at the summation index on the NASDAQ, McClellan Summation Index, still curling around right here, but we're still in bullish context as the parabolic SAR is upticking and it's below it. And then if you take a look at the NASDAQ McClellan oscillator, we did hit a below zero reading today. So this went negative, which is not always the greatest sign. So we'll see here if that divergence, as this has made a high, lower high, this made a high and then a higher high, is going to play out to the downside or resolve to the downside. If we take a look at the 10-year yield, this can also potentially put pressure on growth stocks as the 10-year yield is bouncing from this level. You'd want to see the 10-year yield get back below 3.7, but this thing is moving, moving and grooving right now. If this was a back test and we come right back up to this on a strong move, that could obviously potentially affect some growth stocks. So we'll continue to monitor that and see what happens there. Gold, we saw a little bit of strength today. It was up slightly. However, the candle itself is somewhat bullish, as how we gapped down, went lower, but then we closed more towards the high, which is, could be a potential bullish reversal type 2-bar candle. But we'll see here if we get that continuation. So we broke out, pulled back, boom, pulled back. Are we going to get ready for another boom? Well, we talked about how this could be the possibility of an inverse head and shoulders that could potentially take us back up to that swing high. Copper was also on a big tear today, so that's something to watch. And then oil there too, as well as breaking through that 200-day moving average. So yeah, the Fed's going to be raising rates. right? And they're fighting inflation to get back down to 2%, but yet we're getting, inflationary items start to reaccelerate, which is going to be interesting to see how that all plays out. But that's all I got for you on today's episode, everybody. Hope it helps out. See you tomorrow.